Good afternoon. Welcome to the Deep Dive. Thank you for joining us. We are taking a hard look today at the market action from October 8th, 2025. Really quite a pivotal day, wasn't it? That day, the momentum finally seemed to crack, snapped the S&P 500's, well, incredible 7-day winning streak.
It certainly did, a real attention grabber after that run.
Yeah, so we've gathered quite a stack of sources, focusing heavily on the daily market summary and outlook for that day. And our mission, really, is critical. We need to understand what specific mix of factors, stalled that rally. And maybe more importantly, what does this abrupt rotation tell us?
Right.
This move away from high-growth tech decisively into safety, like gold, which, for the first time ever, surged past $4,000 an ounce. That's huge.
It absolutely is. And it signals, I think, a profound transition. The core conflict, as you look through the data, is that while the main indices did decline, the way they declined was, well, intensely measured.
Measured, okay.
Yeah, our sources, they repeatedly stress this point. This was not some panic-driven sell-off, not like a flash crash scenario. Instead, it was defined quite deliberately as a rational repricing of risk.
Irrational repricing. That distinction sounds really important.
It's everything, because it suggests the market is maybe exiting a phase driven purely by short-term momentum, that buy everything feeling,
Right.
and entering one where fundamentals, political stability, corporate profitability, those are going to be the things that truly matter. It feels like the era of easy, indiscriminate gains might have hit pause. For now, at least.
Okay, so let's unpack that. Let's dig into the heavy hitters, the confluence of headwinds, as the sources called them, that finally broke the tape. It wasn't just one thing, clearly. It felt more like a perfect storm brewing, political uncertainty, economic worries.
Exactly. You had the U.S. government shutdown already dragging on, creating this policy paralysis, this economic distortion. That was a big one.
The shutdown looms large.
Then you had these emerging jitters, particularly among institutional investors, about, well, the near-term profitability and maybe the sustainability of valuations in that high-flying AI sector.
The AI question. Starting to see some cracks there.
Some nervousness, definitely. And then layered on top, investors were just universally stepping back, kind of holding their breath,
Waiting for
crucial Federal Reserve communications. They were scheduled for the very next day, so a lot of anticipation.
Okay, so shutdown, AI jitters, Fed anticipation. That's quite the mix.
It is. And when you isolate the raw performance data from the day, you can really see the market trying to differentiate between these risks. The overall index dip, as we said, was contained. That suggests some underlying stability, maybe institutional confidence hasn't totally evaporated. But the breakdown of sector performance, that's highly revealing about where the market perceived the risk truly lies.
Okay, let's get those numbers out. Give us a snapshot. The benchmark S&P 500, it fell, but modestly right. 0.38%, lost about 25.69 points, finished at 6,714.59.
Pretty contained, yeah. And the Dow Jones Industrial Average, which represents more of those established industrial companies,
Right.
It lost even less, only 0.20%, shed about 92 points, closed just above 46,600.
But the NASDAQ, that was the story, wasn't it?
Yeah, it was the clear laggard, yes. And that reflects that pronounced, very targeted weakness in technology, especially maybe non-profitable growth tech. The NASDAQ composite declined 0.67%. That's almost double the Dow's drop in percentage terms. Lost 153 points, ended the day at 22,788.36.
So that pattern, tech getting hit hardest, that's the classic sign. Capital rotating out.
It's the definitive sign, yeah. Capital moving out of growth, seeking perceived value, seeking defense.
What I find fascinating, though, is even with this litany of negative headlines, as one source put it, the S&P only fell less than 0.5%. You call it repricing, not panic. But if it's not panic, why are sophisticated investors simultaneously rushing into $4,000 gold? Doesn't that suggest maybe a deeper systemic fear bubbling just beneath that calm surface?
It signals a calculation of risk, I think, more than a fear of immediate collapse. Look at the technical action on the S&P 500. It found pretty robust support right around that 6,700 level.
Okay, 6,700. Why is that level significant?
Well, it's deeply psychological. It represents the high water mark the index achieved during the previous quarter's technical breakout. So, holding that level, bouncing off it, it signals that the bulls, structurally at least, still maintain control of the market narrative.
Okay, so if it had sliced right through 6,700.
Then, yes. Then that calculated hedging we saw could very quickly have turned into indiscriminate liquidation, panic selling.
Right. And can you maybe clarify for us, what does that calculated hedging look like in practice compared to indiscriminate liquidation?
Sure. Indiscriminate liquidation is basically mass selling. Across the board, sell everything to raise cash, volatility spikes, treasury yields usually plummet as institutions desperately try to de-risk.
Got it. Everything goes down.
Pretty much. What we saw on the 8th was different. It was a measured rotation, specifically into gold, which soared, and into short-dated U.S. treasuries. And notably, treasury yields only slipped by about 2 basis points. That's not panic buying of bonds.
Okay, subtle difference, but important.
Very. It suggests capital is being defensively redeployed, shifted around, not desperately withdrawn from the market altogether. It means the big players, the institutional investors, are actively pausing that buy everything momentum that defined the previous 7 days.
So the transition phase we're in, it's all about differentiation. Investors aren't necessarily bearish on the whole market, but they're getting incredibly selective.
Precisely. They're asking the tough questions now. Which companies actually have the balance sheet strength? Which have resilient supply chains? Who has the pricing power to withstand, potentially, an extended government shutdown, rising political risk, maybe a slowing consumer? This phase means those broad market factors, what we call beta, they take a back seat. It's the specific company fundamentals, the alpha, that's now commanding the most influence over individual stock prices. That seems to be the new rule book, at least for the immediate future.
Okay, moving to the macro picture then.
Yeah.
The elephant in the room, clearly, is the U.S. government shutdown. Now, dragging into its second week as of October 8th, the political impasse seemed to be intensifying, right? The Senate failed again.
For the 5th time, yeah. Failed to pass the House funding bill, and it fell strictly along party lines. That signals this wasn't something likely to resolve overnight.
Yeah, it felt like it moved beyond just political theater into genuine economic distress territory.
And the real immediate danger, the thing driving market anxiety, was the data vacuum it created.
The data vacuum. Explain that.
Critical economic reports, the September jobs report, the weekly jobless claims numbers, wholesale inventories, all indefinitely delayed. Think about it. These reports are like the navigational instruments for the economy. Without timely, crucial info on jobs and inventories.
How can anyone plan?
Exactly.
Yeah.
Corporations can't effectively plan. And maybe more importantly, the Federal Reserve is effectively flying blind. They don't have the fresh data they rely on.
And that blindness, that lack of data, that directly fuels the rotation into safe havens like gold, doesn't it? If the Fed doesn't know how strong the labor market is, how can it confidently set interest rate policy?
Precisely. Which is why the Federal Reserve moved squarely into the spotlight. The market was basically in a holding pattern, waiting for 2 crucial events. The release of the September FOMC minutes at 2:00 p.m. ET, and then Fed Chair Jerome Powell's key speech, scheduled for the following day, Thursday, October 9th.
All eyes on the Fed's tone.
Completely. All focus was on the tone of those communications.
Okay, let's just quickly remind ourselves, and you listening, of the policy context here. The Fed had recently cut rates, right?
Yes, the federal funds rate was cut by 25 basis points. That was the first reduction since the previous December. It brought the target range down to 4.00% to 4.25%.
And their justification was?
They cited moderating economic growth and a notable slowdown in the previously robust labor market.
Right, but what makes that decision so, well, contentious is that inflation, which should be their main focus, had actually ticked up from 2.3% in April to 2.9% in August.
And this brings us to this fascinating, almost paradoxical, dovish pressure that the shutdown itself imposes on the Fed. This is where the market seemed to be placing its bets. The shutdown basically forces the Fed's hand towards an easing stance, or at least prevents tightening, for 3 main reasons. We could call it the triple threat, maybe.
Okay, triple threat. Let's hear it.
First, the shutdown acts as a blinder. As we said, it prevents the release of critical economic data. Historically, when central banks lack accurate, timely input, they tend to default to a more accommodative stance. They fear they might over-tighten an economy whose strength they can no longer properly measure.
Interesting. So the lack of data itself becomes bullish because it takes rate hikes off the table?
Essentially, yes. It makes much harder to justify. Second, the shutdown itself acts as an economic brake. By furloughing hundreds of thousands of government workers, freezing federal contract spending, the government is effectively injecting a dose of fiscal contraction into the economy.
Ah, so Washington is doing the Fed's tightening work for them, in a way.
Exactly. It's economic tightening without the Fed having to lift a finger on interest rates. This involuntary tightening reduces aggregate demand, it dampens inflation expectations, maybe faster than a typical quarter-point rate hike would.
Okay, so blind or break. What's the third part of the threat?
And third is simply the need for caution. Central banks, globally, typically err on the side of easing policy, or at least pausing tightening, when faced with high, sustained uncertainty, especially uncertainty rooted in political instability that they can't directly control.
Right. They can't fix the shutdown.
No. So the dual effect, the data vacuum and the economic contraction from the shutdown, it substantially increases the probability that the Fed will signal a stronger dovish bias, maybe even proceed with another rate cut sooner than expected. It's ironic, really. Washington's dysfunction creates the very conditions that could justify continued support for asset prices, at least once the dysfunction ends.
We should probably broaden out here, too. Global crosscurrents were definitely adding to that risk-off feeling on the 8th. This wasn't purely a U.S. domestic issue.
Absolutely not. Data from overseas added significant pressure that day. Look at Germany, the Eurozone's economic engine. They reported a really severe contraction in August industrial production. It fell 4.3% month over month. Analysts had only expected maybe a 1.0% decline.
Wow, 4 times worse than expected. That's a big miss. What sectors in Germany were hit hardest? Why does that matter for, say, U.S. investors?
The sources pointed to the auto sector, which is hugely capital-intensive, very reliant on global supply chains, and also Germany's massive chemicals industry. Those seem to be the weakest links. And it matters because it's not just a German problem. It signals a broader cooling of global industrial demand that directly impacts U.S. multinational corporations who rely on European sales, European supply chain stability. It reinforces that whole narrative of moderating global growth that the Fed itself had cited.
Got it. And currency volatility was also screaming risk off, wasn't it? The yen weakened significantly.
Yeah, the Japanese yen plunged past 152.50 against the U.S. dollar, and the New Zealand dollar also weakened quite a bit.
What drove the New Zealand dollar move?
That story is quite revealing, actually. It weakened after their central bank delivered a larger-than-expected 50 basis point rate cut. And the rationale wasn't purely about managing inflation. It was read as a clear signal that the central bank was prioritizing supporting slowing domestic growth over battling persistent inflation.
The classic growth versus inflation dilemma.
Exactly. It reflects that intense tightrope walk policymakers globally are facing right now, fighting sticky prices versus preventing recession. And when growth concerns start to override inflation concerns on a global scale, that's another clear signal for the market to tilt towards safety.
Okay, let's shift to the big thematic stories of the day. They really tell that story of rotation perfectly, don't they? On one hand, you had the market's darling, the high-flyer AI getting its wings clipped a bit. And on the other, the ultimate insurance policy gold, just soaring into completely uncharted territory.
A tale of two assets, absolutely.
Let's start with AI's altitude check. That tech sell-off, you mentioned it, reflected serious rising concerns about a potential AI bubble, right? And questions about whether near-term profitability could genuinely justify those, frankly, massive valuations.
Yeah, this felt like a necessary cooling-off period after months, maybe years, of intense hype. Jensen Huang, NVIDIA's CEO, was notably vocal in media appearances around this time. He was really keen to defend the sector's underlying fundamentals against that bubble accusation.
Right, I remember seeing that. He insisted this build-out is fundamentally different.
Different from past speculative frenzies, yeah.
He specifically contrasted it with the vacuous.com bubble of the early 2000s. How exactly does this AI build-out differ? What makes it less vacuous in his view?
The key difference he highlighted is capital intensity. The dot-com bubble fundamentally was built on promises of intangible assets, website traffic, eyeballs, click-through rates, future ad revenue.
Right, lots of promises, not much concrete stuff.
Exactly. Very little physical capital expenditure was actually required for many of those companies. Valuations were often based on price to sales, sometimes without companies ever booking a real profit. The AI build-out, by contrast, is hugely capital-intensive. We're talking massive physical investments in specialized chips, advanced cooling systems, enormous energy infrastructure, giant data centers, tangible assets.
Okay, so real stuff being built.
Real expensive stuff. And this deployment of tangible capital, arguably, acts as a kind of fundamental floor for the valuation. It makes the current moment less purely speculative, less vacuous. As Huang noted, while NVIDIA's forward PE multiple was elevated 41.6 times earnings, it is grounded in real revenue, real profits, real capital assets, unlike those triple-digit PE ratios on zero revenue we saw back in 2000.
So investors are maybe starting to separate the genuine infrastructure players from the pure hype?
It seems that way, and the market action showed that differentiation, which, as you said, is actually a sign of sophistication, not just blind fear.
How so?
Well, it wasn't a panic retreat from the whole sector. Look at Advanced Micro Devices, AMD. Their stock actually rose 3.8% that day.
Why did AMD buck the trend?
Continued excitement, plus some confirmed details emerging about its strategic partnership with OpenAI. That's a concrete, high-profile deal. Meanwhile, NVIDIA, the giant, only rose a modest 0.7%. And that was even after news broke about a potential $2 billion investment into Elon Musk's private AI startup XAI.
Interesting. So it confirmed partnership mattered more than speculative investment news.
It seems investors were being selective, yeah. Rewarding confirmed partnerships, real deal flow, over perhaps more speculative, longer-term investments. It confirms that fundamentals, specific catalysts, were taking precedence over just riding the general AI momentum wave.
Okay, now for the flip side of that coin, the flight to safety. Gold's historic moment. Spot gold, the futures contract, GC, surged over 1.5%, decisively breaking above $4,000 an ounce. I mean, $4,000, that's just a monumental technical and psychological barrier shattered.
It's truly historic, and that surge was fueled, really, by a perfect storm of converging factors: geopolitical worries, monetary policy concerns. Our sources detail about 5 specific drivers pushing it higher.
Okay, what are they?
First, just immense fiscal concerns, worries about the colossal, rapidly expanding U.S. federal deficit. Second, obviously, high political uncertainty from that prolonged government shutdown. Third, strong market hopes, maybe expectations, for more aggressive future Fed rate cuts. Fourth, those persistent background inflation fears eroding purchasing power.
Still lingering, despite the Fed's focus on growth.
Still there. And fifth, a generally weak U.S. dollar, which makes dollar-denominated assets like gold cheaper for foreign buyers, boosting demand. When you get all 5 of those forces aligning, gold becomes the unparalleled hedge.
And we saw some pretty high-profile money managers echoing this sentiment, right?
Yes, the institutional warning sirens were definitely blaring. Robert Kaplan, vice chairman at Goldman Sachs, he actually called gold's nearly 40% year-to-date rise a red light, something portfolio managers ignore at their peril.
A red light from Goldman. Wow.
And Ray Dalio, founder of Bridgewater Associates, was publicly recommending a substantial 15% portfolio allocation to gold, calling it an essential diversifier in this kind of uncertain environment.
15% is a big allocation for gold.
It is. It shows the level of concern. However, we absolutely must introduce the crucial technical warning here.
Okay, what's the catch?
The speed of the rally has been just dizzying. Gold gained 18% in just over 7 weeks leading up to that $4,000 break.
That does sound incredibly fast. What does that kind of vertical move tell a technical trader?
It screams caution. Be extremely careful. This swift, sharp move pushed gold's relative strength index, the RSI, above 80.
RSI above 80. Explain what that means.
The RSI is a momentum indicator. It measures the speed and magnitude of recent price changes on a scale from 0 to 100. Generally, any reading above 70 suggests an asset is overbought.
Meaning it's risen too far too fast.
Exactly. It might be due for a correction, a pullback, or just some sideways consolidation. An RSI above 80 is deep into overbought territory. It signals that the move, while historic, is probably unsustainable in the very short term. A period of cooling off, maybe some sharp volatility, seems highly probable before the rally could potentially resume.
So the $4,000 price is validated by the fundamentals, perhaps, but the technical structure is flashing warning signs about the immediate path.
Precisely. Handle with care in the near term.
All right, this next section seems to tie that big picture macro concern, the Fed worrying about moderating economic growth, directly to specific company struggles reported on October 8th. These micro-level events, they almost act like real-time data points confirming the central bank's cautious analysis, right?
Exactly. These aren't just isolated company-specific bad news stories. They should be seen as validation of that broader slowdown thesis. The problems hitting Ford, Tesla, the logistics giant FedEx, they all seem to corroborate that narrative of underlying economic weakness bubbling up.
Okay, let's look at the automotive sector stall first. Ford's stock fell pretty hard, over 6%. Why?
A massive supply chain disruption. There was a fire at a key aluminum supplier.
Ouch. How bad was the potential impact?
The report suggested it could impact production across several major Ford models, potentially stretching through early 2026.
Wow, 2026, that's not a short-term blip.
No. And that detail about the duration, potentially lasting over a year, that's key. It highlights just how fragile these just-in-time global manufacturing supply chains still are. A single failure at one critical supplier can ripple across a massive international company. It raises major cost concerns, inventory worries for the whole sector, really, at a a time when consumer demand might already be softening.
Speaking of softening demand, Tesla also dropped significantly, over 4%. This was after they revealed a new, lower-priced EV model. You'd think that'd be good news.
You would think, but analysts were apparently underwhelmed. The fear was that the price point, even though lower, was still too high to attract the critical mass of lower-income buyers that Tesla might need to justify its high-volume projections.
So even the cheaper Tesla wasn't cheap enough for a big chunk of the market.
That was the concern being voiced. And that reaction is a direct comment on consumer wallet tightness, isn't it? If even a supposedly lower-priced EV from the undisputed industry leader is deemed potentially too expensive for key market segments, it suggests broad consumer purchasing power is significantly constrained, particularly among lower and middle-income groups.
Okay, that transitions perfectly into logistics and finance then. FedEx slipped nearly 2%. Why?
They got hit with a JP Morgan downgrade to neutral. And the reasoning cited was risk to their full-year guidance because of a lack of rebound in freight fundamentals.
Freight fundamentals. Explain why that's such a key indicator.
Freight volumes, shipping activity, they are one of the earliest, clearest leading indicators of overall industrial and commercial health. If a giant like FedEx is reporting a lack of rebound in shipping volumes, it implies small businesses aren't restocking inventories as much, large corporations aren't moving goods at the pace they anticipated. It's a clear signal the broader economy isn't exactly humming along.
So FedEx, seeing weakness, is exactly the kind of moderating growth the Fed was talking about, even without the official government data.
Precisely. It's real-world confirmation.
And this concern was mirrored in consumer finance, too, tying back to those potentially squeezed lower-income buyers. JP Morgan also downgraded several consumer finance stocks simultaneously.
That's right. One Main Financial, Synchrony Financial, SLM Corp, Sallie Mae, all downgraded.
What specific pressure are those firms facing? They deal with personal loans, credit cards, student loans.
They are seeing the pressure from the K-shaped economy in stark relief. That's what the sources emphasize.
The K-shaped economy. Remind us what that means.
It means the economic recovery or conditions are diverging sharply. The upper leg of the K is the high-income consumer, who remains robust, spending on luxury goods, premium travel benefiting companies like maybe Delta's premium cabins. But the other, downward-sloping leg of the K represents the lower-income consumer. They rely much more heavily on the personal loans, the auto loans, the revolving credit provided by firms like Synchrony and One Main.
Okay, so the downgrade suggests things are getting tougher for that lower leg.
Yes. The downgrades were specifically predicated on a worsening macroeconomic outlook for that cohort.
So are we talking about increased risk of people not being able to pay back their loans?
Sure.
Default risk?
Precisely. The analysts issuing the downgrades were forecasting rising delinquencies, particularly on subprime auto loans and unsecured personal loans. As persistent inflation and higher interest rates continue to squeeze household budgets at the lower end, it highlights a really serious divergence. You have high-end corporate profits potentially holding up, fueled by things like the AI build-out, while the foundation of broad consumer spending seems to be cracking where it's most vulnerable.
So the Fed's rate cut, citing moderating economic growth, might have been highly targeted at trying to prevent a further slide in that financially stressed segment of the population.
That seems like a very plausible interpretation, yes.
Okay, let's shift gears a bit and look at the technical structure of the market on that day. The indicators seem to paint a picture of, well, profound near-term anxiety among traders, even if the headline S&P 500 move looked relatively calm. The VIX, the volatility index, it eased back slightly to around 17.5.
Yeah.
But it was still pretty elevated, right? Hadn't it hit a two-week high just before that?
It had, briefly touching above 1750, so still elevated, indicating general caution. But the headline VIX, which looks out 30 days, is important. But what was truly revealing on October 8th was the tension baked into the very short-term volatility measures.
You mean like the one-day VIX?
Exactly. The VIX 1D and the VIX 90, which measure expected volatility over just the next trading day and the next 9 days, both of those jumped by double-digit percentages. That's highly specific anxiety.
Wow. What does that acute, very short-term spike in expected volatility signal? Why just the next day or week?
It signals that traders had very little confidence or conviction about the immediate future, specifically within the next, say, 24 to 48 hours. They knew the FOMC minutes were coming out later that day, and critically, Fed Chair Powell's speech was the very next morning. These short-dated VIX indices are essentially a measure of the cost of insurance against a sudden market shock.
Like buying protection just for those specific events.
Yeah. Exactly. When a VIX 1D and VIX X90 spike like that, it means the market is pricing in the possibility of highly divergent outcomes from those Fed events. It confirms that all short-term conviction had been temporarily suspended. Everyone was bracing for news.
Got it. Now, in terms of actual S&P 500 support levels, you mentioned the psychological 6,700 level held. Where's the next sort of structural line in the sand below that?
The next key structural level technicians were watching was the 20-day moving average. On October 8th, that's at around 6,650. Historically, looking back over the prior 5 months of the rally, that 20-day average had served as a pretty reliable support point during pullbacks.
So a break below 6,650 would have been a bigger warning sign.
Yes, a decisive breach below the 20-day moving average would likely have been seen as a technical red flag. It would signal that the intermediate-term momentum was truly broken, and a more sustained correction, perhaps bringing the index down towards its 50-day moving average, was likely underway. Holding above it was key.
Okay, let's talk about the correlation environment too, because you flagged this as critical to understanding the market's character right now. The SIBO's CR3M correlation index was near a low of 14.5. You explained this means high dispersion stocks are moving less in sync with each other. Why was correlation so incredibly low? Is it purely that fundamental differentiation we discussed, or does political risk also drive stocks apart?
It's really a synergy of both, but I'd say it's primarily driven by those fundamentals regaining prominence over the broad market tide, or beta. Think about it. During a massive index-driven rally phase, correlation often gets very high, maybe near 80 or 90. That means almost all stocks go up or down together, regardless of their individual merits. Everyone's just buying the index.
Right, a rising tide lifts all boats.
Exactly. But when correlation drops to a low level like 14.5, it signifies that active managers, the stock pickers, are conducting highly granular stock-by-stock analysis. They're rewarding the select winners, like AMD or Freeport-McMoRan, who had specific positive catalysts, and they're punishing the clear losers, like Ford or Tesla, due to company-specific supply chain or demand issues.
So the political risk just adds another layer, making it easier for company news to dominate.
It exacerbates it, yeah. It makes the market more receptive to idiosyncratic news overshadowing the general index direction.
So this high dispersion, low correlation, it means the overall index movement can look quite muted, quite calm, but underneath the surface, individual stocks are incredibly choppy. This creates opportunities.
Precisely. This environment defines a classic trader's market or a stock picker's market. Passive index investing becomes much more difficult, maybe frustrating, likely delivering only marginal returns in the short term. But for active managers or individual traders who do their homework, this high dispersion creates significant opportunities to generate alpha, that is, to outperform the market by skillfully identifying the winners and avoiding the losers.
And we saw clear examples of that selectivity in action on the 8th. On the winning side, who stood out?
Freeport-McMoRan FCX, the copper miner, rose over 2%. That was driven by a Citigroup upgrade. Citi raised their copper price forecast based on anticipated strong demand from global electrification infrastructure buildouts, a clear fundamental catalyst.
Okay, electrification demand. And PayPal.
PayPal, PYPL, added about 0.8%. That seemed fueled by enthusiasm for a new small business advertising platform they launched. Again, investors rewarding specific product innovation, a potential new growth driver.
Clear catalyst driving them up, while macro weakness hit others.
Exactly. Conversely, the companies perceived to be hit by macro weakness or specific negative news. Ford, Tesla, FedEx saw those sharp drops. This low correlation environment really demands a highly selective investment strategy. Forget just buying the index.
And interesting to note, digital assets seem to remain highly uncorrelated with this tech stock pullback. Bitcoin was still hovering near its record highs, around $121,000.
Yeah, Bitcoin continued to benefit from its own structural tailwinds, largely disconnected from the immediate concerns hitting traditional tech stocks that day.
All right, the market doesn't just stop at the 4 p.m. bell. The after-hours session on October 8th provided some immediate catalysts, didn't it? Focused sharply on M&A chatter and corporate competition.
Absolutely. The after-hours trading often gives clues for the next day's open. The most explosive action was in Confluent, CFLT.
Confluent, the data infrastructure company, what happened there?
Their shares soared after Reuters reported the company was exploring a sale, apparently after receiving some unsolicited acquisition interest.
M&A speculation. That's the ultimate instant catalyst, especially in a market focused on differentiation.
Definitely. Elsewhere, Citizens Financial Group, CFG, saw a respectable 3.76% rise after hours. That seemed tied to positive sentiment around their ongoing push into higher margin private banking services, investors liking that strategic focus.
Okay, but there was downside action too. The price war in credit scoring seemed to hit Fair Isaac Corp, FICO, really hard.
It did. FICO dropped nearly 5% in after-hours trading, which compounded a substantial 9.6% decline it had already suffered during the regular session. A really rough day for them.
What triggered that renewed selling after hours?
It was driven by a highly competitive countermove from their main rival, Equifax.
What did Equifax do?
Equifax announced discounted pricing for its competing VantageScore product. That was seen as directly signaling the start of a potentially brutal price war in what's traditionally been a fairly sticky, high-function financial services sector.
So investors immediately priced in lower future profits for FICO.
Instantly. It cemented that view that when the broader economy moderates, even seemingly safe, established sectors aren't immune to competitive pressures and margin erosion.
Okay, shifting from after-hours movers to the third quarter earnings season, which was just starting to ramp up, investors must have been desperate for some real corporate health data to confirm or deny all these macro anxieties.
Desperate for clarity, exactly. And the few reports coming out after the close on the 8th gave some early sector-specific clues.
What did we see?
Well, these smaller company reports can be really vital for confirming underlying trends. For example, you had AZZ Inc., a machinery company, expected to report solid earnings growth, about 13.87% year over year. Then there was Bassett Furniture, BSET. They were expected to report an absolutely eye-watering 117% year-over-year EPS increase.
Wow, 117% for furniture. That seems counterintuitive if the consumer is weak.
It does, right? So if they actually hit that number, it would provide a key test of resilience for consumer discretionary spending, maybe specifically among mid to upper tier home goods buyers, fitting that K-shape idea.
Okay, and on the other side?
Conversely, you had Richardson Electronics, or ELL. They were expected to show a sharp 75% decrease in EPS year over year, highlighting potentially serious weakness in the specialized electrical components sector.
So these contrasting early results really underscore that K-shaped recovery idea, even at the corporate level. Some sectors booming, others struggling.
Precisely, huge divergence.
But the real focus for the next trading day, October 9th, was going to be on the two major reports coming out before the market opened. Delta Airlines and PepsiCo. Big names. Let's start with Delta. DAL. Consensus was for $1.53 EPS. Beyond that headline number, what specific metrics were traders laser focused on?
The focus was squarely on two things: corporate travel demand and their fuel hedging strategies. Yes, the headline EPS matters, but investors would immediately scrutinize the projected load factor, basically, the percentage of seats filled, and especially the forward commentary on premium cabin bookings. Those are crucial high-margin revenue drivers.
Right, connecting back to that high-end consumer.
Exactly. Bank of America Securities had actually commented around this time that robust high-income spending should primarily benefit these premium carriers, like Delta. So a strong report from Delta would suggest the highest-earning consumers remain completely insulated from any broader economic moderation.
Okay. And the second big one? PepsiCo. PP consensus EPS was $2.26. Here the concerns seemed much more pointed, right? Dealing directly with the mainstream consumer, staples, inflation elasticity.
That's right. UBS analysts, for instance, had publicly expressed concern about PepsiCo facing a potentially challenging quarter. The market would be watching the guidance very closely, specifically anything related to price elasticity.
Price elasticity, meaning can they keep raising prices without losing customers?
Exactly. PepsiCo, like many consumer staples companies, had been raising prices significantly to offset their own rising input costs inflation. But the worry now was about a slowdown in U.S. demand where consumers finally starting to balk at those higher prices for snacks and drinks. Were they trading down?
What other concerns for Pepsi?
The other major concern flagged was potential international softness, perhaps related to higher tariff costs in some regions or logistical challenges persisting in key emerging markets.
So the key question for PepsiCo was, can they sustain their profit margins without sacrificing sales volume?
That's the critical balance. If they guided lower because consumers were indeed trading down to cheaper private label alternatives, it would be seen as a profound warning signal about the health of the mainstream global consumer that could impact the entire consumer staples sector.
Okay, so as we look forward from the close of October 8th, the initial futures sentiment seemed to suggest maybe a tentative low-conviction attempt at a rebound.
Yeah, you saw tech futures, led by the E-mini NASDAQ 100, leading a slight recovery overnight in the futures market. But really, that little post-close recovery likely just reflected the market clearing out some weak hands from the day session, and maybe some institutions positioning cautiously for what they knew would be a volatile opening. Conviction was clearly very low because everyone recognized the two overwhelming market-moving events were sitting squarely in the next 48 hours.
Right. Remind us again what those were.
Thursday morning, 8:30 a.m. Eastern Time, Fed Chair Powell's speech that was universally expected to trigger high volatility. And then Friday morning, the preliminary University of Michigan Consumer Sentiment Report. That would be our first crucial non-government glimpse into consumer confidence amidst the ongoing shutdown.
So it really all boiled down to this central conflict, didn't it? The potentially dovish Federal Reserve versus the politically dysfunctional, data-blinding Washington?
Absolutely. You could frame it as two very strong competing cases vying for dominance in the market narrative.
Okay, lay out the bull case first. What were the arguments for the rally to resume?
The bull case rested on three pretty substantial pillars. First, the Fed's recent easing pivot, that rate cut, is historically supportive of equity prices. It acts as a kind of backstop, or at least removes a headwind. Second, the long-term secular growth story of artificial intelligence is undeniably real. It's built on tangible capital, as we discussed, and the current correction could just be seen as a healthy pause and altitude check before the next leg higher. And third, the eventual political resolution to the government shutdown, whenever it might come, was seen as guaranteed to spark a significant relief rally. That could easily push the S&P 500 back above recent highs, maybe reclaiming 6,750 or more.
Okay, that's the optimistic view. What about the bear case? What were the factors that could unwind the market's current assumption of a supportive Fed and continued growth?
The bear case, logically, focused on the downsides. It posited that the economic damage from an extended shutdown could be far greater and more prolonged than analysts were currently anticipating. It could deepen the stress we were already seeing signs of in freight, in auto demand, in consumer finance. Furthermore, what if inflation proves stickier than expected, maybe fueled by rising global commodity prices or persistent wage pressures despite the slowdown? That would severely limit the Fed's ability to continue easing policy. It might even force them to abandon their dovish tilt altogether.
That would pull the rug out from under the market's main hope.
Completely. And finally, those widening cracks in the K-shaped economy we talked about, combined with maybe higher tariff costs impacting multinationals and weakening international demand, all that could lead to seriously disappointing third-quarter earnings results and significant downward revisions to guidance across large segments of the market.
So the immediate path coming out of October 8th was just absolutely dictated by Powell's tone on Thursday morning.
Without a single doubt. A distinctly, unequivocally dovish message from the Fed chair could potentially overwhelm the negative shutdown narrative, at least temporarily, and send the rally right back into motion. However, that combination of the historic gold surge hitting $4,000 and the extremely high stock dispersion, that low correlation environment, it really mandated a strategy of extreme prudence for investors. Sophisticated players were clearly hedging their bets, recognizing that this was an environment of heightened risk, but also potentially high reward, but only for those who were highly discerning and selective.
So the strategic conclusion coming out of that day was clear. Be nimble. Be very selective.
Absolutely. Focus on companies with demonstrably strong balance sheets, resilient businesses, and ideally clear idiosyncratic catalysts like that M&A news-boosting confluent or the specific product launch helping PayPal. This was no longer a market where a rising tide lifted all boats or where you could just blindly follow the index. It had become a market where security selection, active management, and careful risk management were absolutely paramount.
That analysis really ties together what felt like a very complex, transitional day of market activity. We saw the long rally finally stall, the market clearly stop buying everything indiscriminately, and investors pivot towards selecting based much more on fundamentals, while actively hedging against that huge political risk from the shutdown. And now, everyone waits for the words of arguably the most influential voice in global finance, the Fed chair.
Which brings us, I think, to the final thought for you, the listener, to consider as you digest all this. The government shutdown is actively preventing the release of critical labor data, inventory data, forcing the Fed to make hugely consequential policy decisions essentially with a data blindfold on. The market, as of October 8th, seemed to be banking heavily on the assumption of a dovish Fed, a dovishness fueled largely by that very uncertainty and lack of data. So the question is, how long can the stock market sustain a rally based primarily on assumptions about Fed policy rather than on actual hard economic data? And maybe more critically, until the government fully reopens and those official economic reports finally resume. What new data point, besides Jerome Powell's speeches, will the market latch onto? What will it accept as the most reliable indicator of true economic health?
A fascinating dilemma indeed. Plenty to mull over as you watch the markets navigate the uncertainty ahead. Thank you for diving deep with us today.